Hello everyone, this is Harsha Vardhan Reddy, and today I'm going to make a presentation of subject corporate finance, a final assignment, selecting each topic from each chapter, which makes of total 10 slides of 10 topics from each chapter. So let's dive into the from chap let's dive for chapter 1. So from chapter 1, I have selected a topic of corporate finance and financial manager. The financial scope of corporate finance operates as a fundamental business function which uses financial activities to reach maximum shareholder value. Financial managers hold essential responsibilities which include making investments along with capital expenditure management and leading financial assessment throughout the organization. Corporate finance requires professionals to handle financial planning duties and perform market analysis and risk assessment with risk mitigation practices that enable strategic planning. Resource allocation efficiency maintains its central position in corporate finance operations because it determines both business profitability together with anticipated expansion prospects. So, from chapter 2, the balance sheet topic. A company presents its assets and liabilities and equity values for a particular time through the essential financial statement known as balance sheet. Finance follows the basic accounting principle where assets equal to liabilities combined with equity. A company controls its resources through assets and external parties have liabilities along with ownership equity, which represents the remaining assets. Investing stakeholders analyze balance sheets to assess firm financial status as well as ability to pay debts and understanding of capital funding methods too. The analysis provides key information concerning business functionality together with complete financial framework strength. From chapter 3, cash flows and financial statements. Okay. So the financial statements heavily rely on cash flow information because it demonstrates how money flows through a business operating activities from one of the three primary areas in addition to investing and financial activities. As a connecting document, the cash flow statement explains how the net income transforms into stakeholder available cash. Organizations need positive cash flow to operate normally and grow while handling their payments. But negative cash flow reveals limited prospects that require through examination for sustainable business growth. The solution to achieving solid financial health lies in preserving proper balance sheet between all three segments of cash flow operations. From chapter 4, the financial planning. Strategic financial planning focuses on developing complete rational approaches for handling organizational funds with optimal efficiency. Businesses business organizations need financial planning like which requires budget preparation alongside predictive modeling of future finances and funding search for researching their objectives. So, financial planning enables companies to distribute funds properly while advancing their future development along with market adaptations. The objective is to reduce potential hazards and optimize capital return and maintain sustainable financial operation. The financial planning relies on three core elements, including financial goal setting, as well as information analysis and goal achievement strategy development for economic sustainability. From chapter 4, time and money. According to financial principles, the time value of money, which resembles TVM, reveals that present day funds possess higher worth than future money since they can produce interest earnings over time. Investments together with financial decisions require future cash flow to discount their present value through TVM's vital application. The TVM manifests in mathematical expressions, which includes future value as FV equals to PV into 1 plus R power of n alongside with present value. The formula mathematical expression for present value is PV equals to FV divided by plus 1 plus R power of n. The R here indicates the interest rate while n stands for time periods. The known for TVM enables people to select wisely when saving money and investing or borrowing funds and other financial products. From chapter 6, multiple cash flows like futures and present values. The value of assessment of an investment through discounted cash flow, which resembles as DCF analysis, depends on estimating the projected future cash flows and applying future discounting methods. The DCF demonstrates its worth by predicting future cash flows, which becomes useful after discounting them with an assigned discount rate to determine investment probability. The calculation of present value through DCF requires the calculation of present value through DCF requires the summation of CF t divided by 1 plus R power of t to arrive at the value. Here the CFT indicates the cash flow during period T while R equals the discount rate. The technique helps organizations maintain investment viability by comparing a different opportunities according to their expected discounted returns that account for risk elements. From chapter 7, bond definition. Bond fixed income financial instruments include bonds which function as their essential elements. Like bond stands as a fixed income financial instruments which demonstrate investor established loans towards corporate or governmental entities. An investor use bonds to establish a documented financial relationship between providing money to borrowers who typically belong to corporate or governmental organizations. The various entities, including businesses, together with towns and states and national governments, depend on bonds as financial instruments to fund multiple projects and activities. The main elements of bond requires lenders to receive back their original deposit while receiving periodic interest payments named coupons before the bond expires. The price of bond exhibits an unfavorable correlation with interest rates. So higher rates leads to lower prices while lower rates results in higher prices. From chapter 8, bond and stock differences. Like bond together with stocks constitute essential financial investment tools at each possess different properties. Like bond and stocks from fundamental investing elements which possess separate characteristics. That's what I'm trying to say. Debt securities known as bonds provide regular interest payments until their maturity day until their maturity day because they prioritize investor security. Stocks give investors both voting rights and dividend distributions that depend on company profitability. Through stock ownership, a better stability and lower risk futures characterize bonds than stocks do while stocks deliver potential greater long-term returns yet demonstrate greater volatility. Investor effectiveness in mix and match portfolio strategies depends on their risk capacity and financial targets because bonds differs fundamentally from stocks. Investors who learn to distinguish the different types of investments will make decisions that suit their financial targets. Investors use investors use knowledge of investment differences to decide how to distribute their assets between risky and volatility. From chapter 9, capital budgeting process. Organizations employ the capital budgeting procedure to evaluate investment prospects based on their potential acceptance by organizational targets. The primary tool used for capital spending assessments compromise comprise NPV together with IRR along with payback period analysis. The financial soundness of project becomes clear through net present value analysis. When such projects yield positive outcomes from present value calculations of cash flows, IRR evaluates the discount rate needed to make the project NPV 0 to demonstrate its profitability potential. The analysis calculates when the initial capital investment will regain its total cost during the period of evaluation. Capital investment decisions becomes more efficient through these tools since they enable selection of projects which yield high returns with reduced risks. The NPV formula you can see in the presentation. The NPV stands for net present value. The CF underscore T equals to stands for cash flow at time. The R stands for discount rate. The T stands for time period per year. A C stands for initial investment cost. The IRR is the discount rate that makes the NPV equal to zero, solved by with the formula that is mentioned in the presentation. The final chapter, the topic is evaluating NPV estimates. Firms need proper evaluation of net present value to make informed investment choices. A project's potential profitability can be measured using NPV because it combines financial time value considerations to prove that incoming cash exceeds outgoing expenses. Businesses analysts assess discount rates with projected cash flows in combination with economic conditions when making their investment evaluations. The determination of positive NPV reveals that projected returns will exceed the expenses, indicating a lucrative investment venture. The assessment of assumption changes through sensitive analysis allows improved risk evaluation by revealing the effects on NPV. The examination of well analyzed NPV estimates through complete evaluation helps investors select a quality financial items. The formula for the NPV you can see in the presentation, which we have mentioned the formulas. The PI equals to NPV plus CO divided by CO. The PI is the profit index. In this case, the PI is equal to the net present value plus the net cash flow. So these are the references that I've used to get the information, and that's it about the all the topics that I have selected from each chapter with the 10 topics from 10 chapters. And thank you for giving me this opportunity. uh, Thank you so much.